Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. There are a lot of important things happening for portfolio managers and analysts right now because of the pressures that led to some of the emerging and frontier market defaults last year. Some of those pressures remain in place. And I think the World Bank's view is integral to many of those markets right now. So we're here with Top, who is a senior portfolio manager in the World Bank Treasury, where his primary focus is investment strategy and sustainable investments. If you'd like to read more of his bio, it's on our website. You can also see video recordings of the sessions at which Top has spoken at CFA New York events in the past. But now I'd like to get on to the research. So, Top, welcome to the podcast.
Thank you, Rob. Thanks for having me.
As you look across the World Bank's recent reports, of which there are quite a few, not the least of which is in importance is the 49th debt report, which is an amazing achievement. What do you see?
Look, in the first instance, I'm very lucky to be at the bank where we have this many people that work in kind of the developing world in what investors would call frontier markets and emerging markets. A lot of dedicated individuals and we have a lot of feet on the ground. So what that means to me is that we have a lot of deep knowledge of the countries that we write about, and we bring a lot of experience to bear in the research that we produce. So for me, that's a great benefit, and I would hope that for the people that take time to read those reports, it's something that they digest fully, because it does take a lot of work and a lot of people to get that done.
That's right. I was formerly an analyst at Fitch Ratings, and the debt report was a sort of jaw-dropping amount of depth.
Yep, absolutely. And look, and I think sometimes it maybe is not clear just how much work it takes to bring all of that data together and to make it into something readable and coherent. And so a lot of kudos to the people that end up producing that research. It's really a stunning piece of work when they do it.
Yeah, it is, sure is. So what do you think is important to know about some of those recent things that might whet the appetites of some of the analysts and portfolio managers who are listening to this podcast?
Look, I think certainly in the World Bank Treasury, for the team that I lead, we subscribe to a philosophy around our investments of deep work, right? And so the idea there is that whilst there's a lot of space for systematic strategies and looking at try to simplify the vast amounts of data that we get to make decision making easier, I think particularly in these markets, that subscription to deep work is vitally important. I think you need to really understand the context, the nuance in some of these countries, and some of the areas, the pressures that are being brought to bear on them, as well as the opportunities that arise for investors, right? Because as we know, sometimes it's not around a point in time; it's around the trend. And certainly, as an investor, if you're searching for alpha, you really want to be able to try and identify where those trends are, and that's not going to happen simply by maybe taking a point in time piece of data or a point in time piece of research. It really is around trying as far as you can to understand if you're looking at a particular country, understand that country context very, very well, and look into not only obviously the traditional financial aspects. I think those obviously will always be important, but we're now seeing that growing trend towards looking at all the kind of sustainability and ESG data. And there's a lot of relative value to be gained in looking at what are the trends going there, and what are the countries doing that are going to be able to bolster some of their positions going forward. Because ultimately, especially in these countries, those ESG factors have a huge amount of bearing on the financial factors later on, more so than you might see in the developed world. And so it really is important to take that holistic view of the research that's being produced there.
Yeah, I think that is an excellent point. One of the things that's exceptionally important to a lot of people who are running those organizations, NGOs, et cetera, within the emerging markets and frontier markets, is they say sustainable. Everything we have to do is sustainable. It has to be sustainable. We can't pay for a new one next year.
Right. No, exactly that. Yeah.
Yeah. So, one of the things that's always a little bit challenging about the data around these markets is its timeliness and some of its cleanliness. So how do you all get around that? I know you mentioned basically people in those places that is one of the assets for your team, but how else do you all handle those issues?
Well, I think let me start by saying, again, one of the tenets of being an analyst is, don't let perfect be the enemy of good. There are some things that you literally just cannot get away from, which is, sometimes the timeliness of the data that's being produced and how well cleaned it is. And so, I think everyone's got to get to some level of comfort around, well, for this particular piece of data, this is how reliable it's going to be. And this is, even if I'm able to somehow do some personal effort or some organizational effort to reach out to the countries and say, hey, I don't quite understand what is happening with the stats that you've brought out on this, that, and the other. I think there's got to be at some point, don't end up with paralysis by analysis, but just get comfortable with, this is the data set that I've got. But, to come back to a point I've just made, that idea of actually doing some work yourself to try and reach out to the countries. Now, I'm saying this in the knowledge that many of the countries maybe don't have the capacity to maybe deal with a lot of the requests that we might make. But there's a lot of work being done to change that, right? Where, the bank, certainly I know, does a lot of work with ministries of finance, with debt management offices, to try and tell them about the importance of having people on the, available to speak to investors around data availability and cleanliness. And so I think acknowledging that, these countries are not the developed countries that we're used to in some ways, and having big DMOs and having great stats offices. But again, it's around that trend. If you see that people are putting in place the facilities or the resources to try and respond to investor questions around this, that's a very good signal, right? But if you see that maybe some countries are saying, well, I couldn't care less what that data looks like, and really just, it is what it is, use what you have, that's also a signal in many cases, right? And so I think I would say, I would summarize all this by saying, the data is not going to be perfect. We know that, but it's improving. And we're a long way today than we were 10 years ago. But also, just do what you can to try and bridge that gap, reach out. And I know many other investors who actually use that, again, as an alpha generation tool. If you're willing to be out there and visit the country or pick up the phone or whatever it's going to be, then that's your opportunity to produce more returns.
Yeah, that's a great lesson to take from those things. Some of the risks that we saw last year were basically around the military action in Ukraine. So that was largely unpredictable. So as many of them are, right? Some of them simmer for a long time and nothing happens. And then some of them simmer for a long time and something terrible happens. And it's it's exceptionally difficult to be in that business of that type of prediction. Do you try and do any forecasting with that, or do you simply position a portfolio to be ready for those types of things?
No, I think predictions are difficult. But with that said, I think to your point, it's really about maybe assigning some level of likelihood to certain outcomes, right? And so, and your portfolio then has to kind of be positioned accordingly. Now, I think we can all be honest and say Ukraine is probably the biggest flare-up that the international capital markets have had for a very long time, right? Just because of the massive geopolitical impact they had. And to your point, very, very unexpected. Now, I think that will have changed investors' stances on the way that they view a lot of data and a lot of news flow that now comes out around potential military conflict and escalation in different areas of the world now. So, I think many people would probably have ascribed a probability close to zero of this happening last year. Now, should analyst reports or whatever start coming out around possible escalation of military tensions in different parts of the world, I don't think you're going to be anywhere close to zero in where people ascribe that probability, right? That I think that Ukraine has jolted people out of a kind of a malaise they had around events that could have big impacts on the geopolitical arena. Now, when it comes to the developing world, obviously we always see, and it's almost a constant feature of many of the regions that there are tensions, that there are ongoing civil wars or conflicts that obviously disrupt things in a very local way. And so again, where people are looking to invest in those areas, you really need to understand the context and nuance, because then you're really able to, I think there's a more of a likelihood of understanding what the probabilities are of tensions flaring up, and then that having a big effect on the investments in that specific region.
Yeah, that's a great point. I think that there was a really valuable learning that came out of that. I think that we're also kind of learning that you don't need to be one of the top 5 markets in terms of size or import-export ability to impact the global supply chain either.
Exactly.
And I think that there's an awful lot of talk right now about reshoring and onshoring or some kind of shoring. That will take a very long time.
Yeah,
that is not gonna. We're not gonna push a button and change that. So that risk remains.
No, absolutely, and to some extent, to your point around all these discussions around reshoring or whatever else, the response would be to such a rupture in what was a fairly well established kind of global trade architecture and global economic linkages will be probably again that return to fully understanding what it is that makes a company profitable and or secure and or prime for growth, what it is that makes a country particularly vulnerable. And I think it's kind of a return to the pre kind of systematic strategy days where you really had to understand where things were going and how profitability was made to really make a difference. And I think that's all to the good, right? You really want analysts to go digging deep for what might drive portfolio returns. And so I think that there's going to be a lot of work being done, obviously all through last year, but certainly going forward around how do we calibrate risk? How do we really, do I really understand this country and this company and the potential linkages to other things that maybe I hadn't thought about in 2018 or 19, but have to think about now because they could cause a big disruption.
I'd like to sort of go down a couple of thousand feet now in sort of altitude and ask you some specifics about things that are sort of that I've been wondering about within ESG. Do you think that ESG investments generally are adapting pretty well to the new normal in higher interest rates?
Very good question. I think, well, yes and no, which is not going to be particularly helpful for you, but yes, to the extent that, look, if you think about ESG in two different buckets, right? There's ESG as input, and that means I'm using ESG data to really just look at the risk and return associated with my portfolios, and try to optimize, the risk return characteristics, or at least improve risk adjusted returns. And there's no real adjustment to be made there because ultimately what you're looking at is, what am I exposed to on this non-traditional factor side,
right?
And how is it going to affect, what happens to me? And I think that, there's no, I don't see the big adjustment necessary there. I think it's part of the normal investment process. Now, if you think about ESG as output and I'm trying to get some specific outcome that's related to either sustainability, maybe an environmental goal, or social governance. Now there, I think it's a little bit more complicated because ultimately these ESG factors, they work at different speeds and have different impacts. And so as you think about a higher interest rate world, then you then have to factor in, well, what does that mean, for example, for many of the investments that were needed to bring about better environmental outcomes? Are those less or more likely? When on the curve, when in the maturity curve, are they likely to materialize? Is it sooner rather than later? Similarly, with many of the kind of social goals, like are people now willing to make either the investments needed to bring about some of the outcomes that we wanted? Or are we less likely to do so because when everyone's now a little bit more pinched, inflation is higher, rates are higher, and so the sacrifices that are needed to bring about some of the outcomes and goals that we wanted now are just more expensive to make. And so for that reason, it would be kind of are there either investors or asset owners willing to maybe compromise on some of their earlier goals, or are they going to dig deeper and say, actually, this has shown us that we do need more resilient economies. We do need a kind of fairer outcomes in terms of the social economic situations in around the world. And so that's why I say it's complicated. It's not clear to me yet. What I have been heartened by is the fact that there does seem to have been a kind of recommitment to a lot of sustainability goals because of what happened in 2022. There was a lot of momentum prior to that, but I think 2022 has shown that the world is not as resilient as we thought, right? Because you saw that the disruption in 2022 had very differing impacts around the world. Now, in the West and for most of the developed world, that manifested in higher prices for energy and for some of the things that we were used to. In other parts of the world, it meant like people could not buy food anymore because it just was not available. And so I think there's been maybe a strengthening in commitments to many of those kind of big picture sustainable development kind of issues that existed prior.
Yeah, I totally agree with you. I'm exceptionally heartened by the approach to getting by on less within energy policy and energy sensibility that people have.
Yeah, absolutely.
That is integral, as a lot of the energy technologies are going to take a while to get here. So we need to do some serious less usage in the meantime. Yeah. That curtailing that is going to be the only way we're going to make it. Perhaps we should leave it there, as that's a real positive note.
Not a problem. Thanks, Ron.
Thank you, Top. And this has been Compound Insights, and I'm your host, Rob Rowan.